The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
So I'm sitting here at the PDAC, which is, of course, the biggest mining conference in the world, and I'm sitting next to a gentleman called Mickey Fulp. Mickey is also known as the Mercenary Geologist, and that is the name of his website where you can find some of his work. And Mickey's very good at sourcing out the... how do I put this? The BS in the mining industry. He's good at identifying companies with genuine deposits that might work and those that haven't got a hope. And your presentation this morning, Mickey, was excellent, and it was called The Good, the Bad, and the But Ugly. So why don't we start with the good? Let's start on a positive note. What do you like? What do you look for in a mining company, and why?
The nature of this talk is juniors and metals and their flagship projects. So good, the bad, and the ugly basically refers to types of deposits and commodities that I consider a junior can be successful in. And there are four key criteria within that. A timeline to from exploration, development, permitting, and most juniors have a lifespan of 5 to 8 years. So you need to pick a project that can be further advanced to a development
that
decision
can work in that time frame.
Otherwise,
why do you say 5 to 8? Is that because after that time they get diluted?
Yeah, they blow out their share structure by equity financings. The other would be low cost producers, and that's kind of a no-brainer, which is the lowest quartile with peer comparisons. Another key criteria would be exit strategies. So a company that has an exit strategy of selling to a major, that happens about 1 in every 200 times. So you need a project that will have multiple exit strategies. And finally, a key criteria.
So in other words, either it'll become a mine, or a major will buy it out, or
the company can develop a mine itself. It's not too big. So you need something not too small, not too big, and middle-sized project.
You don't want to be relying on selling to the greater fool, in other words.
Right. And the final thing is access to capital, because a legitimate junior might be able to attract singly 50 to 100 millions, perhaps in some cases $200 million for capex for a mine. And so they have to be able to raise that capital for me without an external party, a major mining company, or some entity that they essentially have to give the deposit away and control the company in order to finance it.
Okay, so now you used an example. Was it the Bingham mine you used as an example, which is the biggest? Tell us about the biggest. Tell us about your example, the Bingham mine.
Okay. Well, the Bingham mine is one of my bad criteria, and that would be.
Okay, fine. Have we done the good? Should we move on to the bad? Or?
Well, let's go and do. So I laid the groundwork on how the good works. The good and the bad and the ugly. I've laid the groundwork. Now let's go from the good. Okay. So I like open pit heap leach oxide gold deposits because they're open pitable, they're cheap to mine, they're low cost to put in production. And in an instance like Nevada, you can have a low cost gold mine in production from start to finish in 5 years.
Okay.
I also like in situ recovery or copper oxide deposits, which in copper oxide deposit is really analogous in terms of its capital expenditures, its margin over operating margin, etc., very similar to an oxide gold deposit. The final good for me is ISR, in situ recovery, or open pit heap leach uranium.
Okay.
And they're very similar in these three types of deposits in the fact that they have low capex, they have good margins, they are quick to develop, they are easy to permit in the right jurisdiction. So that's something, and there's multiple exit strategies. You can sell to a bigger company, you can develop yourself, you can joint venture with somebody, do a strategic alliance, you can build a mid-tier company by combining 2 or 3 small juniors, make a mid-tier gold producer on the order of what Gold Corp started with that that sort of idea, and built a major mining company eventually.
So in other words, I mean, in mining terms, I'm a rookie compared to you. But in other words, what you're looking at, every company that I've been invested in that has built a mine has encountered some kind of hitch on the way. So in other words, you're looking for companies where there is going to be the minimum of hitches.
Exactly.
Okay, so let's move from there to the bad, shall we?
Okay, so the bad would be examples. Well, polymetallic deposits, because they require big mills and high capex, and they also require smelters, which leads to third-party risk, because no junior is not going to build a smelter. There's basically 5 or 6 companies in the free world, and I'll exclude China, that run the world's smelters. So
how much does a smelter cost to build?
I have no idea.
Okay,
I have
silly money.
Billions, silly money.
Even sillier than the price that the gold price is going to in a few.
So I don't like polymetallic deposits. That would include lead, zinc, silver, VMS, volcanogenic massive sulfide, the nickel, cobalt, platinum, copper deposits. For instance, Voisey Bay, found by a junior, but developed by a major. Yeah. Right.
But within those things that you don't like, you were very generous and said, there are examples of companies that can work.
There's always these are rules of thumb, okay? And there's always exceptions. And so you mentioned briefly there Bingham Canyon. Well, it would cost probably $10 billion to put Bingham Canyon into production again. I mean, that mine has existed since 1842. It was the world's first open pit copper mine. It's been in continuous open pit production since 1903. It will go until you and I are long gone and our grandkids are on the planet, right? Okay. It will go and go and go. But to do something like that now requires extensive capital expenditures. The lead time to develop from exploration to delineation of a significant resource to development permitting is a very long time frame for any of these porphyry coppers, well on the order of 10 to 15 years. So that
would you include kind of Ivanhoe's mine in Mongolia in that category?
BHP is now the partner, right? Yeah. So they can't do it themselves, and we've seen the struggles they've gone through on that. Yeah. So there is exceptions to every rule. A good exception in porphyry copper would be Antares and Hakira, and so they were able to sell that deposit. But you've got to get 5 billion pounds before you're going to attract anybody for a sale, and that takes a long time. Yeah. So those are 3, and then my final example of ugly deposits would be giant iron ore deposits, and those are big integrated steel companies. So a junior
because the capex is so big on iron ore.
Yeah. So it's you're going to end up selling to cliffs, or if you find something big enough. But chances of finding something big enough are so slim that I tend to stay away from those mega deposits.
Yeah, a lot of juniors. What is the chance of finding something massive? Is 1 in 100,000 or something?
Yeah, well, 1 in a couple of hundred probably in the junior resource sector, and there's 1,750 of these companies, so you're looking at less than 10 will ever sell out to a major in this regard with those kind of big deposits. Okay,
so we move from the bad to the ugly.
Right.
The butt ugly.
The butt ugly, which always gets a laugh. So, and those would be...
Let me ask you one question. Where do you stand on those kind of bulk tonnage, low-grade gold mines, like the kind of a Cisco, all those ones on the Cadillac trend? Where do you have an opinion on those?
They work. They do work.
Oh, they can work.
They can work.
Because that sort of mini sector's been in a bit of a bear market. I mean, everything's been in a bear market.
But a Cisco, it's been quite a long, drawn-out affair for a Cisco. Yeah. I don't really follow a Cisco. I don't know if they're profitable yet. Yeah. I presume they are. But those will work, but they're better things for me. So, the good is the stuff that I'm really interested in. And that doesn't mean that I won't speculate in other things just to play a trade, but the companies I cover are going to meet my criteria.
Okay, very good. But ugly.
Yeah, and so that would include things that the supply-demand commodities, the supply-demand fundamentals are not strong. It will include sub-economic deposits, and it will include deposits that are, or commodities that are controlled by monopolies or oligopolies.
Okay.
And so then I gave some examples of those. So
go on, give us an example.
Yeah. So an example of something where subeconomic deposits would be volcanic hosted uranium deposits, because there are no known examples in the world outside of Russia where a volcanic hosted uranium deposit has actually worked.
I see.
I gave an example of the Makasani district in Peru.
I know, yeah.
And I don't think that's viable.
Okay. I mean, or maybe they'll only work if the underlying commodity triples in price or something, in which case it's very, very risky, because what happens if the commodity then falls?
Right.
That's what happened with your molybdenum example.
Yeah, so I use moly and I really dislike moly porphyries because the world's moly mines are not really moly. The world's moly supply, let me say, is about 90% from byproduct of copper mining. So as goes copper, so goes moly. Also, as goes the steel industry, so goes the demand for moly.
And the same applies to all those steel hardeners.
Yeah, I don't like ferrous metals because that's big boy football, if you will. So I used moly porphyries as an example. I used specialty metals. I very much dislike, for the most part, specialty metals. And
What's that, things like antimony and beryllium?
Lithium and beryllium and tantalum and niobium. I use an example of Araxá in Brazil, which is a monopoly that basically controls 85% of the world's niobium market. Whatever Araxá wants to do, they determine the price of niobium. They can make it rise, they can make it fall, they can flood the market, they can do whatever they want to. So that's a monopoly. And there's oligopolies in lithium space. There's been a couple of juniors that have succeeded, but that whole lithium bubble has burst, and there's been 100 companies fail in lithium space.
I had a gentleman from an antimony company on this show, and the company had a market cap of something like $5 million, and they had, I think it was a 15,000 ton historic resource. I can't remember the exact numbers, but you were able to arrive at a valuation of their resource at $500 million, but the company never did anything.
Yeah.
So, I mean, do you have a view on antimony, for example?
We say antimony in the States, so I'll say antimony.
Okay.
I have looked at antimony.
Yeah.
There is room in antimony space for a junior to succeed if you can find the right standalone antimony deposits. Most of the world's antimony comes as a byproduct of dirty smelters, as does cadmium and bismuth and various other metals that oftentimes occur with zinc and lead. Right? Indium's another one. So there may be a space in the antimony world if you can find the right standalone antimony deposit without all the other stuff.
I understand.
Because you can build your own small antimony.
The problem with those niche companies, though, they're quite easy to sell. But then you can go on. I could go on stage and give you the antimony story and look at Chinese antimony demand versus Chinese antimony production and all that, and you go, I've got to buy antimony. But I've yet to see one that's really worked.
Yeah, well, so have I, and I beat up pretty good on the specialty metals and the ferrous metals, but there's always, and then I kind of ended the talk by talking about these are rules of thumbs, and there's always exceptions, and so let's go to an exception in the beryllium world. Yeah. Beryllium is a monopoly controlled by Brush-Wellman in the free world, and there's basically two producers of beryllium in the world. Spore Mountain in Utah, Brush-Wellman, and then in Kazakhstan there are stockpiles of beryllium that comes out of a processing plant, former Soviet Union. So in antimony space, part of my, even in the Bud Ugly, integrated specialty metal companies can work, and integrated, that's mine to market, right? Yeah. And one of those which works now, although they have some share structure problems, is IBC Alloys.
Yeah, friend of this show.
Yeah,
Yeah.
And I think very highly of the management. The problem, they should be cash flow positive sometime in the next year or so. But they are an integrated beryllium company whose main business, cash flow business, is beryllium alloy products, copper beryllium alloy, and now they've got some patents on beryllium aluminum. The problem I've had with that company, of course, is too many shares outstanding, and I think we both hope that they're going to address that. They address that in the near future.
Okay, now Mickey, we're kind of running a bit low on time, and I've got a couple more questions. We kind of reached the end of your presentation, and these are the things you need to look out for when you're investing in a company. And if that's not your area of expertise, then as an investor, we need to turn to newsletter writers like yourself who can separate the wheat from the chaff, so to speak.
Well, I appreciate that.
So I want to ask you, why don't you give out your website and tell us about the service that you offer, and then I'm going to ask you about one other metal after that.
Okay. The website is mercenarygeologist.com for bilingual and Chinese readers. We launched in the first of the year mercenarygeologist.asia in simplified Chinese. I run a sponsorship-based model, meaning that the companies that I am invested in and I cover, and I have a self-imposed limit of 10. I'm covering 9 companies right now. They pay to sponsor my website, which allows me to give a totally free subscription service to my subscribers. So all you have to do is go to my website, sign up. You get products that are restricted to my subscribers. My picks come out and restricted to subscribers, and a lot of the other stuff, the educational stuff that I try to do is free to the public on the website.
The last question I've got for you, tin. That was on your list on the but ugly list. Tell us why you don't like tin, and what could persuade you to like a company that is exploring for tin.
I don't like tin because of historic cartel, the tin cartel, which controlled the price in the 80s and the 90s. I have not looked at tin enough to know if tin is something I should be looking at. Perhaps it is, but I just am going by history and the tin cartel, and you've been around maybe not quite as long as I have, but you have plenty of gray hair. I don't have any hair anymore, but we both remember the tin cartel.
Yeah.
So your point's well taken. I think the point you're trying to make is maybe I ought to take a look at tin.
I've just got a tin company I like.
Yeah, I'd be very interested in talking to you about this tin company because there are exceptions to every one of my rules of thumb.
Okay. Now, in 2009, I watched you do a presentation in downstairs at this very same convention, and you said that the next. I think you said the next bubble, but the next kind of glory metal, if you like, the next one everyone's going to get excited about is rare earths. And this year, you said everyone's going to get excited about
graphite.
Graphite is the new rare earth, is it?
It's going to be a bubble. It's early on right now. It's a good time to get into a favorite graphite play if you have one.
How many graphite companies are there?
I don't know right now. Here's what I am realizing, that every shark, snake, and charlatan in Vancouver, in other words, most promoters are looking for a graphite play to fund a graphite company right now.
Is that right?
So it is the newest thing on the block. I think it's going to be the next big thing. I have one.
How do you mine graphite?
Very easily mined. Most mines are open pit mines. It's just mined, and it's a standard processing technique of grinding, of flotation, of recovery of a concentrate, of drying it, sacking it, and shipping it. So it's a very standard mine mill process. The key is you need to make a very high grade graphite concentrate. 95% or better graphite. The other key is the flake size. So the great demand is in what's called large flake graphite and not amorphous graphite, which the Chinese have. The Chinese are running out of large flake graphite.
Okay.
So I see an opportunity in the graphite business right now.
Okay, that's interesting. And well, you heard it here first, ladies and gents. And we'll all look at our tennis rackets in an entirely different way from now on.
Grip it and rip it, they say on the golf course, right? So
and our golf clubs as well. Absolutely right. Mickey Fulp, it's been a real pleasure. One more time, the website.
mercenarygeologist.com, mercenarygeologist.asia.
Okay, thank you very much, Mickey.
Thank you, Dominic. It's a pleasure.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.